My next guest says when picking blue chip stocks, look for the triple threat. Jeff Reeves is a columnist at Market Watch, and he joins us now with his latest investing strategy. Welcome, Jeff. Great to see you again.
Good to be back.
All right, go ahead. Sum up your latest column for us. Triple threat.
Well, I mean, we're into March Madness right now. I think a lot of people are thinking about basketball. And, when you look at some championship teams, it's nice if you can find some kind of gimmick plays and make a run in the tournament because they got ball stoppers or because they can rain down threes. But I think for investors, you don't really want to have a gimmicky portfolio that jumps around. You should try to do all things well. And I kind of look for stocks that did three things in particular. You got a strong balance sheet, good dividend, you got growth potential, momentum in shares, and then you also have strong profit growth. I think those three things that's what I call a triple threat stock. And I identified three of those companies that I think would be a really good buy for any investor.
All right, well, let's check the boxes. But what are the risks there that you have to keep in mind? Because there's so many uncertainties out there in the geopolitical landscape and just the domestic economic landscape. A lot of conjecture, a lot of debate as to where we go from here. So of those things I just kind of blanketed there for you, what would be the one thing to keep in mind?
Well, I mean, you're completely right, and that's one of the reasons why I think you need to have a diversified investing strategy across these kind of metrics. And, I mean, I personally find a lot of value in dividends. I think that if you have a company that reliably has a revenue stream that they can share with shareholders instead of spending on, boondoggles that never pay off. Hewlett-Packard did a bunch of buyouts that haven't done anything for the company. I'd rather have that money as a shareholder. So I think that's very important to have because not only does it give you cash that hedges against the downside, it proves the company's doing right by its investors. It's not spending its money irresponsibly.
All right, to your point, the triple threat number one, dividend. Intel's company, you give an example, they've had a steady increase in dividend over the last couple of years here. Shares are down a little bit today, and boy, Intel doesn't make chips for the all-popular iPhone, and it might give it a bit of a dinosaur reputation. Isn't that a liability?
Well, yeah, some people do think that it's a dinosaur, but the one thing you have to realize is that ARM, the company that makes the iPhone chips, is a fabless semiconductor. It means it's not a foundry business. It doesn't actually make them. It just designs them. Intel makes 16% of all the chips used in the world. So that's actually the reliable revenue stream that provides for the dividend, for that 3% dividend yield, is because they sell so many chips regularly. Now, you can say they probably don't have the same upside potential as maybe some of these sexier design shops,
Sure.
But Intel is getting into it. I mean, they have a smartphone that they're launching in Europe that they've actually designed soup to nuts. It's got their components. So they're trying. I think they have the good dividend. So that's check one with a 3% dividend yield right there. $15 billion on the balance sheet. Their outperformance is pretty impressive. 3 years,
the market
they've gone
share,
up about.
They own it.
Yeah, and the stock price has gone up about 30% in the past 5 years, 20% in the last 12 months. So they've outperformed tech, too. They haven't just outperformed the market.
All right, Jeff, I'm running out of time. I got to interrupt you because
Okay.
we have to get to Caterpillar and McDonald. So Caterpillar, you warned, don't think it's cyclical, and it lives and dies by the health of the housing market. Caterpillar is way down today, actually. And then McDonald's had a great 2011, best stock in the Dow. It's faded, though, a little bit year to date. Let you comment quickly on both of those.
Well, yeah, I mean, Caterpillar, actually, Intel I think is attractive, too. It's got a good price-to-earnings ratio. Caterpillar's in the same boat. It's got a PE of a little less than 12 right now, despite some impressive earnings growth over the last couple years. Caterpillar was a big outperformer a couple years ago. But the reason I think it's got some growth potential going forward is because it also has a mining business. It's not necessarily just buying those backhoes and graders that you see next to roadsides in America. They're a big emerging market company. They serve miners in Latin America and in China. And the other thing that's really encouraging to me about Caterpillar is if you look at the dividend, it's only about 1.617 right now, so it's not that impressive. But their payout ratio is only 24%. Historically, S&P 500 stocks hand around 50% of their profits back to shareholders. So I think there's a dividend bump in the future.
Sure.
You've got a lot of good growth for the company. I mean, there's a lot of things to be excited about.
All right, Jeff Reeves, we'll look for your columns in Market Watch. Thanks a lot.
Thanks for having me.
Up next, another